Good morning, everyone. Welcome to this final legacy class for the year on Home Buying 101. My name is Teresa McDuffie, and I am your Legacy Program Director. I hope everyone did well during the storm. Well, it's a bright, sunny day today, so we're very thankful of that. We have a wonderful class for you today. We have a wonderful speaker, Shakima Chapman is here with us today. She's an expert in real estate. We all know that home ownership is part of building that generational wealth. So Shakima is definitely going to help us with all that we need to know in regards to home buying. Shakima is the owner of the Chapman Group and a broker associate with Keller Williams Realty. And before I introduce her, I want to let you know to please feel free to ask any questions that you may have. Add your questions in the chat, and as the speaker takes breaks, we will have a moderator that will ask your question for you. So just go ahead and do that, and we'll get those questions answered for you. So now I want to go ahead and introduce our speaker. Again, we have Shakima Chapman. She is a graduate of South Carolina State University with a Bachelor of Science in Elementary Education. Her professional career, she has served many roles in education, corporate training, and software consulting before starting her career in real estate. Shakima released her first book titled Possess the Land, The Believer's Guide to Home Buying. Her mission is to help every individual to possess land as God has promised them. So we want to welcome you, Shakima. So glad to have you.
She just had a quick technical issue, Teresa, so she's going to log back on right now. No.
So it looks like I had myself on mute, so no one heard what I said. So the speaker is getting logged back on, but I want to make sure that you guys are aware that we do have a Facebook page now. It's under My Legacy Program. So go ahead and follow us on that. And also you can subscribe to us on YouTube under My Legacy Program altogether. We do have our past videos on YouTube, and we will be recording this video and posting it to our YouTube page as well. If you want to go ahead and add your questions, if you had any questions in the chat, and we'll make sure that your questions get answered. All right, and we're just going to give the speaker a few moments to get logged on here. All right, and I see that she is on. So Shakima, if you can hear us, you can go ahead and start whenever you're ready.
Apologize. I had a little technical difficulties. I got shut down. So give me just a second to get the PowerPoint back up. And are you guys able to see my screen at this time?
Yes.
Okay. All right. I apologize. Don't know what happened, but that just means that this is going to be a powerful session. Anytime I face opposition, I know that someone brought a whole lot of Jesus in the room, and we're just going to move on and press forward. I'm going to skip over my bio. I think they just went over that. But today, the goal is to equip you with information so that you can tap into what I feel is the most powerful wealth producing activity that you can do, and that is to purchase a home. Just a little quickly about the Chapman Group. I am the team leader of the group. Me and my team members, Alicia and Danielle, service here locally in the Charleston area. We have about 19 years combined experience, and we are proud to say that we are a top producing team in the area. And most importantly, we are dedicated to your results. So after hearing this information, if you would like to work with my team, I can definitely tell you how that can happen. So today I'm going to walk you through the steps to buying a home, but I'm also going to tell you about some common mistakes that I don't want any of you to make in that home buying process. As a result of going through the things not to do, I'm also going to equip you with information about how to get pre-approved, what to look out for in regard to going through the actual process. So if that's okay, I'll go ahead and get started. So the first, you've actually made the first step today, and that is by gaining knowledge. What I have found, and what I often quote in my book, Possess the Land, A Believer's Guide to Home Buying, is that some of us are fighting mindsets in regard to home ownership. We hear things like, well, I don't make enough money, or my credit is too bad, or no one ever in my family was able to buy a home. So the best way, as described in the Bible, that you combat the enemy is with truth. Just as when Jesus was in the Garden of Gethsemane and the enemy tried to tempt him, he always came back with truth. And so today, the purpose of this class is for you to renew your mind and give you truth in regards to home ownership. The next thing we suggest you do is sit down and do a buyer consultation. I'm going to give you some information today to give you a general overview of home ownership, but it's going to be best that you sit down with a professional to go over your specific situations. Everyone's home buying experience is going to be different, especially in an ever-changing market. So often we encourage you to consult with a real estate consultant, because as well-meaning as our friends, our family is, they may be giving you information that is outdated, especially with the way that the market is changing. I'm finding the advice I gave people in January of this year is very different than I'm giving to someone now. So that should be, after this class, should be your next step to do a home buyer consultation. The next thing you'll need to do is get pre-approved. We're actually going to spend quite a bit of time talking about the qualification for pre-approval, so I'll pause there for just a second. Once you're pre-approved, that is what I call your ticket to shop. This is where you now can go out and search and find a home with your agent. And I'm just going to speak on the current market. In doing that process, when you're planning out your timeline, a little more time for this particular process now. We are still in, especially in the Charleston area, in a seller's market. So the inventory that is out there may be a little slim. So it may take you a little longer to find the home that you're looking for. And then even when you find the home that you're looking for, you may face some competition. So when you are thinking about buying the home, and after you leave this class, I challenge you to really put to paper and start writing the vision of what you want that home to look like. How many bedrooms? Where should it be located? And also, and create that as a vision. I'm huge on visioning and putting that down to paper. And I see the questions coming in. What I'm going to do is hold the questions until like halfway point, and I'll answer them and we'll jump back in. Also, then once you find that home, you'll go through an offer and negotiation process. As I said before, the market is a little competitive. So your negotiations may consist of you being informed that there are 10 other people or 5 other people or 3 other people bidding at the home. And at that point, you need to put in what we call your best and highest offer. In doing so, the lender, I suggest you do things like consider how aggressively you want to make your offer, but don't go overboard. I truly believe what God has for you is for you, and he will not withhold any good thing from you. So you may find or feel like this is your dream home, but it just may not work out, and that's okay, because that's not the good thing that God has for you. Now, once you actually find the home and get under contract and accept it, the first stop is going to be to do a home inspection. I'll talk a little more about home inspections in just a bit. And then you'll go back and finalize your financing. So initially, you'll do a pre-approval, you'll give the lender some information, but until you find the actual home, all of that is kind of hypothetical. You go back to the lender once you have your actual home and finance that process. And from there, you go to closing and moving in. So the steps are just that simple. But what I want to make sure and go over and spend some time with you is ensuring that you don't make some common mistakes that home buyers make. So the first mistake is ignoring first-time home buyer programs. I'm going to go over a few programs today, but do your research, what's available to you. So first-time home buyer programs are usually specific to region. So you may have friends who live in Georgia that may talk about programs that are just not available here in South Carolina or in Charleston. And I say Charleston specifically because I find that Columbia has programs that are not in Charleston. So note that programs are specific to region. A lot of times there are income requirements associated with it. And usually when you do things like down payment assistance, it's usually a second mortgage tied to the home. So when you go to sell the home, your lender may have another lien that comes up. Sometimes those loans are forgivable, meaning that as long as you stay in the home a certain period of time, you don't have to pay the money back. And then sometimes those loans are just due in full at the end. We'll talk about a few of them and the differences in each. And then also, do you need down payment assistance or no down payment assistance? There are some programs where down payment assistance is not necessary because there is 100% financing. So let's talk about a few options. First option you want to look into is a bank 100% or maybe a low down payment loans. These are programs that specific banks have put together to make homeownership affordable. Just to give you an example, Synovus Bank, TD Bank, those are some banks that have a 100% finance loan. Now, the thing about when you're looking at these programs, you want to do some comparisons because 100% financing means you don't have to put any money down as far as a down payment. There are still going to be some costs associated with the loan in the form of closing costs. So when you're looking at those programs and comparing it to traditional programs, the thing you want to pay attention to is what fees are associated with these 100% loans. Because while the bank is generously giving you a loan that does not require down payment, sometimes they get their money on the back end with fees. Sometimes it may not be 100% financing, but it may have a low down payment, like 3%. There's a new program coming out in Georgia. Hopefully it'll make its way to South Carolina where the down payment is as low as 1%. Now, statewide, there is a South Carolina Housing Home Buyer Program. This program will give you $8,000 towards your down payment assistance. There is a maximum purchase price, though, with this loan. The home can't be over $325,000. And what happens with this loan is you get a 10 to 20 year lien against the home, meaning that based on your income, if you live in the home 10 to 20 years, depending on which one is assigned to you, that loan is completely forgiven. However, there are some folks who will be over the income threshold where the loan is forgiven a certain percentage each year. So let's say you got $8,000 and you have the 10-year lien against the home. You sell the home after being in the home for 5 years, you're still going to owe $4,000 because each year a portion of that loan has been forgiven. There is also Shanoa Down Payment Assistance Program. This is actually a grant that you would have to pair with particular lenders that offer this program. They provide 3.5% towards your down payment. Good thing about this one is that it is a grant, meaning you do not have to pay the money back. But again, you'll have to stay in the home a certain number of years before they forgive that particular grant. Pay attention to this one while you don't have to pay the money back. Again, usually where you see these down payment programs, they kind of recoup their costs. It's through the fees. Palmetto Heroes is another program that is available in our area. This is good for people who are in the public service industry, our firefighters, our nurses, our hospital workers, our teachers, our police officers. They are granted up to $10,000 to assist with home ownership. Again, this one is income-based as well. So depending on your income, you may or may not have to pay these funds back. And it's usually a 10 to 20 year loan, 10 to 20 year lien against the home again. But it's helpful for someone who does not have cash up front to be able to use this loan. Federal Home Loan Bank is another grant program where you can receive down payment assistance. Again, this one you'll have to pair with the lender that offers their services. And then first-time home buyers should all look into VA loans, USDA loans, and an FHA loan. We're going to talk a little more about USDA and FHA. So I just want to briefly talk about the VA loan. This is for our active and veteran service members. So if you've served our country, you can qualify for a VA loan. That is 100% finance, meaning you do not have to have a down payment, but there are going to be some closing costs. What I like about the VA loan for our service members is it does not have a fee attached to it called mortgage insurance. And we'll talk about mortgage insurance in just a bit when we talk about our FHA and our conventional loans. Now, there are basically 4 types of loans. There is your conventional loan, your FHA loan, your USDA loan, and your VA loan. So let's talk about these loans. So I'm going to talk about the FHA loan first because it's the most common that first-time home buyers will use. So this particular loan has a low down payment of 3.5% and usually a down payment requirement of $580. But here's my disclaimer. You can qualify for an FHA loan with a 580 credit score. However, I encourage you to get to at least a 620, 640. Reason being, while you qualify for the loan, you are going to experience additional what they call overlays or requirements. In other words, the loan is going to be more difficult to process. Your debt to income ratios are going to be a little lower. They're going to require a lot more documentation than if you just worked on your scores and got them up to the 620. Now, there are some programs that will do a loan as low as 500. Not recommended, but if you are able to qualify at that 500 score, it's going to require you to do a 10% down payment. And they are definitely going to ask for a lot more paperwork, a lot more documentation, and they are going to require you to have a lower debt to income ratio. Now, one thing about the FHA loan is that's good is that it's easier to refinance if you need to, especially the way rates are changing. And we'll talk about when is a good time to refinance. One, FHA rates tend to be lower than some traditional loans, and they do allow you to have a higher debt to income ratio. Usually that is between 50 to 55%. And so when we talk about debt to income ratio, basically when you apply for your loan, not only is the lender going to look at your credit, but they are also going to look at the amount of money you have coming in versus the money that you have going out, reported on a credit report. The key word is reported on your credit report. So they're not going to take into consideration like your daycare bill. They're not going to take into consideration your grocery bill. They're going to take into consideration anything that is reported on a credit report and do a calculation, basically dividing what you have going in versus what you have going out. With the FHA loan, you can have a 15 to 30-year fixed rate or an adjustable rate term. Now, adjustable rate terms, so 15 to 30-year fixed rate means that through the life of the loan, your rate remains the same. Adjustable rate mortgages means that the rate adjusts based on market conditions. So right now, you'll start to see more lenders offer what they call adjustable rates. Adjustable rates are not horrible, but they are for people who are going to be extremely disciplined in their finances. And the reason being, if you get an adjustable rate mortgage right now, rates are running between 5 and 7%. And a lot of people hear that and they freak out. But being in the industry over 11 years, to me, rates are going back to normal. We saw rates dip to like 3%, 4%. That was historically low. So what you'll start to see now are lenders offering adjustable rates, meaning that they may offer you a lower rate now that will adjust with market conditions. The reason why I say anyone who takes an adjustable rate mortgage has to be disciplined is that when you see that rate going to a point where it is beyond what you can afford, you're going to need to refinance that loan. And in order to be able to refinance, they're going to talk about your credit, your debt. So sometimes when people buy a home, they kind of get that goal, they achieve the goal, they bought the home, they start maxing out credit, they're not as diligent with their credit score, and then when it's time to refinance, they can't qualify. There are some loans now called a 2-1 buy down. I want to give the distinction between those that are paired with FHA loans. Now, a 2-1 buy down basically means the lender is going to give you discounted rates for the first 2 years. So let's use the scenario, you qualify for a 6.5% loan, right? The first year in a 2-1 buy down, the rate is going to be 4.5%. The next year, it's going to be 5.5%. And then the third year, it will go to 6.5%, and it will remain at 6.5% the life of the loan. This is a safer adjustable rate because the rate will never go higher than whatever you locked it in. It's beneficial because you have those savings in the first years, and you can watch the market to see if you have the opportunity to refinance before it goes to that 6.5%. But back to what I said before, you're going to have to be very diligent with your finances, keeping your debt low and maintaining your credit scores. You can use down payment assistance with an FHA loan. So, for example, I told you about the Shenoa grant. That is 3.5% down payment assistance. FHA loan is 3.5% down payment. So you can take a grant and apply it to that down payment. Sellers can contribute up to 6% of the closing costs for your FHA loan, but I will say that in this particular market, you may not necessarily get a guarantee that the seller will help with your closing costs, because closing costs are just that. They are your costs associated with the loan. So the only way the seller is going to contribute as an incentive. And if you're in a competitive market, you have two people trying to buy a home, one needs down payment assistance and one needs help with closing costs and one doesn't, who do you think that seller is going to be more likely to actually go with in a competitive situation? The person that doesn't need the closing costs. So while you can ask for up to 6%, I always coach my buyers, be prepared to pay your own closing costs. Now, the difference between an FHA loan and a conventional loan. A conventional loan is going to be a more traditional loan that is either offered to the bank. The difference is an FHA loan is what we call a government-backed loan. With an FHA loan, you pay mortgage insurance. And also, you hear the term insurance, so you know there's some protection, right? There is protection for the bank. When you pay mortgage insurance on your FHA loan, essentially you pay an additional fee other than your principal, interest, taxes, and insurance. You pay an insurance fee. You pay this fee so that if you default on the loan, the bank that gave you the loan can make a claim with the Federal Housing Association and get that loan paid. So the downside of a FHA loan is you pay that additional insurance, but they feel like they're taking a risk with you because you have a lower credit score and you may have higher debt. Now, the down payment on the FHA loan is 3.5%. Down payment on a conventional loan can be anywhere from 0 to 20. And it's because it is bank defined. So with that being said, when you're looking at conventional loans, it may make sense for you to look at multiple banks simply because they may have different loan programs. With an FHA loan, as we talked about, the minimum score is 500. If you have a 10% down payment, not recommended, but you can go to 580, but 620 is what is recommended. With conventional, you're looking at having to have a little bit of higher credit score between 620 and 680. The difference between FHA and conventional also comes down to debt to income ratio. Usually with an FHA loan, you can go as high as 50%. Conventional, they're a little lower. They want you to stay between 45 and 50%. And when I'm talking about these ratios, that includes the mortgage payment. So once the lender looks at, okay, your card payments, your credit card payments, if you have a finance loan and your mortgage, that number needs to stay under these debt to income ratio thresholds. There are limits for loan amounts. With an FHA loan, the limit is 420. And then with a conventional, it's 647. Anything higher than that, you go into what they call a jumbo loan product. Now, you have to come up with a down payment. So here are some things that you can and can't use as a down payment. You can use 401k or retirement accounts. I encourage you, if you do this, to speak with your human resources coordinator and find out what penalties are associated with that. Because not only you may have to pay that loan back to yourself, but there are also going to be tax penalties. So before you do that, make sure you speak to your HR person and find out the cost of doing that. You can also get a gift. Someone that is close relation to you can give you the money to go towards your down payment. They just usually have to submit a letter stating that they do not expect you to pay back. Also, the lender may also ask for information from them, like their bank statements and their tax returns. So if someone is willing to give you a gift, you need to make sure that they're aware that the underwriters are going to want to see where they got the money from too. You can use stocks, you can use bond, and you can use seasoned cash. So when I talk about seasoned cash, you can't use money that you have sitting under your mattress that you cannot document. The lender is going to want to see that this money has been in your bank account for at least 2 months via paycheck or something. So you can't just go pull mattress money, right? So things you cannot use: credit cards. You cannot charge your down payment, and you certainly cannot take out a loan. I had this happen to me. I had a buyer before closing, a week before closing, they took out a finance loan for the down payment. Their loan was immediately denied. You cannot use debt for your down payment. Undocumented cash, that goes back to that mattress money. You can't just show up to the closing table with a briefcase full of cash, or you can't just dump money into your account without documenting where it comes from and it be used. So the second mistake that buyers make is they don't get pre-approved. They may start to fall in love with the houses, looking at houses, and neglect getting pre-approved, and then discovered that the house that they are in love with, they can't even qualify. So let's talk about what are the 3 things that you need to be concerned about when getting pre-approved. Credit, income, and down payment are all part of the factors. So when we talk about your credit, the mortgage lenders are going to pull what they call a tri-merge credit score. So the only way that you can see your tri-merge credit score other than applying for the loan is through a website, myfico.com. I'm going to type that in the chat. I'll go back. Okay, so myfico.com is the only website that will show you all of your FICO scores, because there are actually 8 different FICO scores. The ones, though, that are used for a loan are FICO 5, 4, and 2. So I know you may be pulling your credit on Credit Karma, or you may on Credit Sesame or any of those sites. Those are what we call Vantage scores. Those are not going to be the scores that the lender actually uses. They're going to use your FICO 5, 4, and 2. Only way to get those is to go to myfico.com. They charge you like a $32 a month monitoring fee to pull those scores. So they pull all 3 of those 5, 4, 2 scores, and what they will do is they will pull from the 3 bureaus, Experian, TransUnion, and Equifax, and they will throw out the highest score and the lowest score and use what is in the middle. And that essentially becomes your mortgage score. Now, one caveat to that, there are some lenders, banks that have special home programs. So for example, Synovus Bank comes to mind, where they only look at your Equifax score. But if you're in the process or you're considering buying a home, you need to be working on all 3 credit scores, because you don't know which one will end up not being used. They'll also look at your income. Usually they're only going to allow you about 1/3 of your income to qualify for the home loan. And then once they tack into your mortgage, you're not going to be able to go in the highest instance over 55% in your debt. And then they'll look at your assets. Do you have stocks? Do you have bonds? Do you have anything else that you can contribute to your down payment or the purchase? So it's important for you to get pre-qualified, because it's going to answer a couple of questions for you. It's going to determine how much home you qualify for. You can look at a $500,000 house, fall in love with the $5,000 house, but you have to be qualified for it based on your income. So it's important to get that done before you look at homes, so that you are looking at homes within your budget. Also, it's important for you to determine what's your budget. You may qualify for the $500,000 loan, but you may not feel comfortable paying that monthly payment, because I never want anyone to be what I call house poor, meaning that the only thing that you can do is pay your mortgage payment, and you can't buy your kids a Happy Meal if you want to. You never want to be in that position. It will increase your buying power with the seller when negotiating. A seller is going to consider your offer over those that have not taken the time to get pre-approved. Some sellers won't even look at your offer until they know that you've gotten a pre-approval. It's going to help you estimate your monthly budget. So back to what I said, the lender may qualify you for one thing, but you want to make sure that you are in that comfort zone. So you can ask the lender, hey, I know I qualify for $500,000 loan, but I only want my payments to be $1,800. What budget should I stay within? So in addition to what the monthly budget is, it's also going to help you figure out what your total investment is. Because when the lender does that pre-approval for you, they're also going to give you an estimate of what your cash to close is. That's going to include what your down payment is and any closing costs. So it's important for you to know that upfront. And then it's also going to be an opportunity for you to identify what loan product works best for you. Like I said, there are different types of loans. By talking with the lender, you're going to have an opportunity to see and do some comparisons and see which one best meets your needs. So things to do to remain pre-qualified. Call if you have questions. Once you get pre-approved, do not do anything. Your loan officer becomes like your godfather, because simple things that you do could change your ability to qualify. Like even paying off a collection. If you qualify with that collection, don't touch it. Don't do anything unless the lender advises you to. Continue paying your mortgage or rent, because the lender may call your landlord right before closing and verify that you've been up to date with your rent. So keep up with those payments. Do not quit your job even after you've been pre-approved and cleared to close, because they will also verify your income to ensure that you are still employed right before closing. It could even happen the morning of. I've seen loans get denied the day of closing because someone has quit their job. Stay up on all existing accounts. A late payment is detrimental to your credit score. So if you're 30 days late on something while you're through the process, the lender's going to verify your credit again right before closing. And if your credit scores drop because you were late on a payment, it's going to cause you to be denied. Expect results from the loan officer. Throughout this process, they are going to ask for a lot of information. Just put whatever they ask for in a little folder, and if they ask for it again, show it again. And whatever piece of paper they ask for, provided. In 2008, we had a huge market crash, and that's because lending was very loose. And so to compensate for that, now they require a lot more documentation, because the underwriter's job is actually on the line if you default on the loan. So they're going to be very cautious of approving you, and sometimes that may require you to give them additional documentation. So some things not to do. Do not, I repeat, do not make large purchases. If you need a car, wait till you get your keys in the hand. If you need furniture, wait till you get keys in your hand. Because if you take out or make a large purchase, that can increase your debt to income ratio, and that will in turn cause you to get denied. Because once you are in the process and you've applied, the lender actually has alerts on your file that if you open a new credit account, they are alerted. Don't change banks or make large deposits, because it makes it harder for you to document your cash. Don't transfer balances for the same reason. You're just going to go into problems of documenting all of your cash. Do not close your credit card accounts. And people are thinking, well, Shakima, that's a good thing. I'm not using credit. But when you close your credit cards, what you do is lower your credit history, which in turn could lower your credit score. Same with consolidation. That will change your credit score. Do not apply for new credit. Part of your credit score is based on your credit inquiries. So when you go to Belk and they offer you 15%, just tell the nice lady, I'm trying to buy a home. I cannot have my credit pulled. Do not co-sign or for anyone, because even though you may help your mom get the car and your mom makes the payment, when they look at your debt to income ratio, they still count that payment, that even though mom is making it, they count it. So that's going to hurt you. And do not max out your credit cards during this process, because that's going to change your credit score. 30% of your credit score is based on utilization. And so you maxing out your credit scores can cause your credit cards can cause your score to take a dip. Another mistake that people make in the approval process is they go with their bank. So here's the things about the bank, and I'll use mine for example. I have been a member of Navy Federal Credit Union for going on over 30 years. My dad got me the account when I was like 15. Love them for a bank, not necessarily for mortgages because they charge large fees and discount points. And then also what I've found in working with large banks, sometimes you're just a number. Whereas when you work with a local direct person, you can get answers and you can get direct access to your lender quickly. A lot of times the banks have stricter guidelines as well. So don't be discouraged if you apply at Navy Federal. Just because Navy Federal turned you down does not mean that a direct mortgage lender will not. The requirements are different. And large banks may not offer any type of down payment assistance programs. So now that we talked about the financing side, I'm going to take a pause for just a second and answer the questions that are in the chat. And then if there are any more questions or if anyone wants to come off mute, Lucrette, I'll let you tell me how you want to do this.
Okay, so I'll go over the first question that was put in the chat. So the question was, is pre-approval needed when building as well?
Yes, and I want to distinguish between the two. Whether you're building with a new construction builder who is offering you the land and the home in one package, that's going to be required. And when you're building, if you already have land, because you still need a loan. And here's the thing about building on your own land, you actually close on that loan before the home is finished. So you definitely still need to get pre-approved.
All right, perfect. And the second question was, how does all of this work with self-employment?
Great question. So when you're self-employed, when they look at your income, they're going to take 2 years of your tax returns and look at your income after your deductions and determine that as your income. So I know I'm self-employed, and a lot of times we write off a lot because we want to limit our tax liability. And that's great for tax perspectives. But if we write off too much when we're buying, it may look like we cannot qualify for the loan. See this a lot with like truck drivers. They can make $180,000 a year, but spend, write off $150,000 in expenses. So from the qualification process, they're only going to be able to use $30,000 of their income to qualify. So that's the biggest difference. It's in the income bracket.
And then another question is about manual underwriting for those who may not have a credit score. Is that something that you typically see?
So if you don't have a credit score, there are some lenders that will use what they call non-traditional trade lines. So they will, and when they talk about a manual underwriting, they will, so let me go back and back up in the process. So when you apply for a loan, the lender uses an automated approval process, right? They plug in your information and they get an automated approval. In the case where you may need a manual underwriting, they actually have to go to a person and get you approved. And a lot of times there are going to be some banks that may use non-traditional lines of credit, such as your rent. They may even use like your cell phone payment history to count, to help come up with a credit history for you. But that brings up a good point. Unfortunately, credit in America is necessary, right? A lender is not going to lend you hundreds of thousands of dollars if they don't know how you manage money. So even if you get a small credit card just to build up a score, that is recommended. Pay for gas and pay it off. Don't overcharge it.
All right, and that's all the questions in chat.
Okay. All right, so moving along, the next mistake I want to talk about that people make, which is buying directly from a builder when you're doing new construction. So let's talk about that. A lot of times new construction companies will offer assistance with closing costs. And that's like, woohoo, good, free money. But you also have to compare what those costs are. So I recommend before you do any type of new construction shopping, you go ahead and get a pre-approval from your bank. That way you can compare, because while they're offering you the closing costs, sometimes they can offer you a higher interest rate. So having a pre-approval for another lender helps you in two ways. It gives you something to compare with. And you can actually have these two lenders, because no one wants to lose the deal, compete for your business. So you can go back to your lender and say, hey, XYZ builder is offering me $5,000 in closing costs. Can you match that? And then just pay attention to what is it actually costing you for that closing cost? Because again, the lender may be offering you $5,000 in closing costs, but may be at a higher cost. I'll give you an example. I had a buyer, the difference between what the lender was going to offer them and what the builder was going to offer them was $1,600 out of their pocket. If they went with their lender, they would have had to pay $1,600 out of their pocket. However, the lender was offering them a lower rate that saved them $100 a month. So what I told them was, well, in 16 months, you will recoup that $1,600 in saving in the lifetime of the loan. You're going to save over time. They still decided to go with with the builder, but I wanted them to understand that over the life of the loan, they were going to be paying less if they went with their lender. It's also important to understand that a realtor works for you and a sales agent works for the builder. So as nice as they are when you come onto site, they are actually licensed real estate agents working for the builder. You have the right to bring in your own realtor, and most times the builder is going to pay your realtor's fees. So you get representation for free. It's like going to the court without a lawyer. If the other side has a lawyer, you want to have someone representing you too. A realtor can help you make the best financial decisions as far as your build. Sometimes buyers can go into the design centers and they add all these crazy options. We're going to talk to you about what makes sense, because you can add all these options, but then your house does not appraise. And guess who's going to have to come up with that difference? So a realtor can help you, guide you through those decisions. Also, a realtor is going to help you through the inspection and walkthrough process. Even though it's a brand new home, you still need to get that home inspected, because humans are building the house and humans are capable of making mistakes. The next mistake I see folks make is skipping the home inspection. And we saw this a lot as we went through this crazy bidding war. One way to get your offer accepted was to skip the home inspection. Not on my watch. Anyone who wanted to skip a home inspection, I actually made them sign a piece of paper saying that, hey, I decided not to, because I didn't want that to come back on me, because there are important things that you find out through that home inspection. You may find out that there's something about that home that might be a deal breaker. There's something wrong with the foundation. There's a hole in a roof. And you could be inheriting major risk if you don't take the time to invest in that inspection. Also, sometimes the inspection will help you forecast future costs. So you may buy a home where the roof is not leaking now, but the inspection determines, hey, in about 5 years, you're going to need to replace this roof. And so you can start planning for or projecting that cost in the next 5 years. Now, the home inspection is going to focus on a lot of things. They're going to show you everything from if there's a crack in the wall to if the paint, is smudged. But the things that you're going to be concerned about are the appliances, the plumbing, the electrical, the heating, the air, the roof, the general structure, and the foundation. Those are the things that you are going to want to be cognizant of. Another mistake I see folks make when buying a home is they overlook the extra cost of purchasing a home. So these are additional costs outside of the down payment. Most people focus on down payment. Prepaids. when you buy a home, you have to pay the taxes and insurance up front. So be prepared to pay those at closing. Then there are closing costs. These are the fees that the lender charges you to do the home. They may have origination fees, they may have title search fees. All of those fees are going to be associated with closing the home. And so that's why, again, you get that pre-approval so you know what those closing costs are. A lot of people do not investigate HOA fees. When you're buying a home, ask your realtor, what are the HOA fees, not only monthly, but what are the HOA fees to move into the home? There's some neighborhoods where you pay what's called a capital contribution. You pay into the neighborhood, and some of those fees can be extensive. So for example, Coosaw Creek, the gated community, their initial capital contribution is $4,500. So that's in addition to your down payment and closing costs. You need to be aware of what HOA fees you have to pay. Earnest money. Earnest money is money that you put up front to hold with the lender while you are going through the lending process. So you need to know what you have to pay in earnest deposit. Usually it's about 1% of the home. Now that's not additional money you pay. That's money that you have just sitting with the attorney or the real estate company until you close, but you need to have access to that money up front. Home inspection fees. A home inspection will cost you anywhere between $300 and about $600. And the reason there's a range is because depending on the age of the home, the size of the home, whether it's on a crawl space or a slab, that fee is different. Appraisal, sometimes you have to pay this up front or sometimes you'll pay it at closing. But if you have to pay it up front, you need to be aware you're going to need between $500 and about $650. You need to budget for maintenance and repairs. So you are going into home resale. Sometimes there may be things that you need to have done after. You need to consider those costs. And moving costs, a lot of people don't think about that. You may have to have hire movers and things of that nature. So just prepare for those costs. And then utility costs. Sometimes you may have to pay deposits moving into a home. So you need to consider all of those costs. So it's not just the down payment you need to be concerned with. You need to budget for all these costs. Now, some of you may already own a home and you may be considering refinancing. I want to talk about that briefly. Before you actually refinance, you want to know what your home equity is. I'm going to drop a link in the chat in just a second. If you want to pull a quick equity report, I can send you one. You just go on the site, put in your information, it'll give you. It's important to know that before you refinance. You still want to know what your credit scores are because that's going to determine the rates that you can get on a refinance. And the same with your debt to income ratio. You need to know what that is. Cost of financing, refinancing, that's important. A lot of times you'll hear them say it's not going to cost you anything out of pocket, keyword out of pocket. A lot of times when you refinance, it's costing you the same as when you closed the loan before. So that can be anywhere from 3 to 6% of the loan cost. Where does that go if it doesn't come out of pocket? A lot of times they tack that on to your mortgage balance. You need to understand if your goal is to refinance for the rates or the term. If you're lowering just the rate, it may be you're looking for lower monthly payments. But if you're refinancing to refinance the terms, you may be looking to pay less overall, because if you pay a loan over 30 years versus 15 years, you're going to pay less in the long run in 15 years because you're going to pay less interest. Understanding if you're buying refinance points. So points are reductions off the interest rate. So sometimes the lender may be able to offer you a lower rate, but you're buying that rate. And that goes to my next point, knowing your break-even point. Because if you're buying that rate or you're taking into consideration the cost of the refinance, you have to ask yourself, does it make sense? So for example, let's say using a flat number, $5,000 total cost to refinance, right? And it saves you $100 a month. it's going to take you 50 months to really see the savings on that refinance because you got to recoup the $5,000 that you've already paid. If you're going to move out of that house in 3 years, does it make sense to refinance? No. So you have to ask yourself those types of questions when you're refinancing. So I think this is a good point to stop as well. So the questions, Lucreta, I'll let you.
Yes, so we have a question about where do you find a list of attorneys that work with real estate purchases?
Probably best to ask just a real estate agent. I can give you a few. Weeks in Irvine probably do about 70% of real estate transactions. In Charleston, Suttles Law Firm is another one, Butler and College. So probably best just to ask a real estate agent.
Okay. The next question, do you see many programs or grants for first-time home buyers? And, you know, do you foresee an uptick in programs becoming more available?
So those are the programs that I talked about. And what first-time home buyers have to understand is while there are things to assist, like down payment assistance and lower down payment programs, those are the programs for first-time buyers. There's going to be some cost associated because even when you have programs where it's truly 100%, you still have to have money in the bank in the form of reserves. They want to see that you have 3 months worth of mortgage payments in some instances. Do I predict more programs? I'm not sure. It seems like the gap between homeownership, especially sadly in our community, is becoming bigger. So those programs are needed, but I cannot predict. But just recapping some of the things that I talked about, the 100% programs with some of your banks off the top of my head, Synovus Bank, TD Bank, South State Bank all have 100% programs. Or you can get South Carolina Housing Authority 3.5% towards, $8,000 to assist with home ownership. But please hear what I said and understanding that there's usually some cost associated with it, whether it's a lien against the home, a higher interest rate. You need to compare and count the cost of using some of these programs.
Okay. And we have one last question, actually two. Home is paid off, but needs repairs. What is the best option?
I would take a look into a home equity loan and compare it to, believe it or not, to a credit card and whatever has the lowest interest rate.
Okay.
So if you, and usually the home equity loan, but rates are so much higher now. So you got to always look at the cost of borrowing money. If you have to borrow the money, if it's going to be a higher interest rate on your credit card, go with the home equity loan and vice versa.
All right. And our last question, should newly graduated college students rent first before home buying?
If you are financially able to buy a home, sometimes you're going to find that buying is going to be cheaper than renting. And here's the thing about home ownership. You want to get in this game as early as possible. Even if you buy a starter home, get a roommate, have them help you pay your mortgage payment. And when you're ready to move, you've now built equity in a house that you can move forward. When you move out of your rental, they may give you your earnest deposit back, but if you buy a home, you could, and notice I'm saying could because rates, markets change, so home values change. You could walk away with equity to move into your next home. But if you can qualify for a home and you're financially stable to do it, I'm always going to advocate buying over renting.
All right, and that was all the questions.
Okay, so a couple of things before we wrap up, I just want to bring your attention to. One is an initiative that my team and I have, if you guys can help us spread the word. It's called Impact 100. What we started to see was buying a home has become a lot harder for people to come up with down payments and closing costs as the market shifts. So what my team and I decided to do at the beginning of the year is we've decided every time we do a closing, we put away $250 of our commission to grant homeowners $5,000. We've given away our first grant. We're about to give our next. So if you can spread the word, anytime you buy or sell a home with the Chapman Group, we are pouring back into others. Our first grantee was a 21-year-old young girl who we were able to give her $5,000 to help her move into her home. And the other thing I want you to be aware of, a lot of times when folks approach home ownership, they encounter what I call giants. And those giants are usually credit score, debt, and savings. So I wrote a book in 2017 addressing this topic called Possess the Land, The Believer's Guide to Home Buying. Well, this year we relaunched the Possess the Land financial counseling services. And what we do, we not only assist you with your credit, but we also provide you financial coaching to help you increase your credit score, to help you lower your debt, and to help you increase your savings. So that is all that I have. Thank you all for the opportunity. I guess, Lucretta, you can give out my information if anyone has any additional questions.
All right. Thank you so much, Shakima. That was amazing information. I jotted down a lot of details here. You gave us a lot of do's and don'ts, common mistakes and things to consider. And these are things that really build up our knowledge and help us to save money when we're purchasing a home. So I encourage everyone to definitely look at this recording. That'll give you the opportunity to pause it and just really go over the details that Shakima presented to us. So again, subscribe to us on YouTube. Our YouTube page is My Legacy Program. It's all together. All of our videos are on that page. Give us a couple days to post this one, but I encourage everyone to definitely go back and look at this. This has been fantastic, fantastic. Thank you so much, Shakima. We really appreciate that. Yes, we really appreciate that. Did anyone have any other questions, any final questions or thoughts? Okay, so if you think of anything after this video, please reach out to us or Shakima. The Legacy Program's email is legacyprogram227@gmail.com. So if you think of anything and you want to email us, send us an email and we'll make sure that we get your questions answered. Again, also follow us on Facebook. Our Facebook page is My Legacy Program. I want to thank everyone for joining us. And if you participated in any of the other classes that we've had this year, thank you so much. We hope that everything that we've gone over for you this past year has been helpful and beneficial to you. Look out for the classes that we will be having in 2023. Follow us because we will be posting details on our page. All right, thank you so much everyone for joining us. Please have a wonderful weekend. Bye-bye.
Bye-bye.